Hello traders and welcome back to another video. One of the most issue with new traders today is stop loss. They usually put the stop loss based on emotions rather than a strong methodology behind it. I see often the tendency of the new traders to put a very tight stop loss, aiming for a higher risk reward without considering market volatility. This type of trader usually blames the market for his loss and don't try to improve his trading system. After watching this video, this problem will be gone. I will show a mathematic method in order to define the best stop loss level for your trades based on the current market volatility. I bet you have heard this indicator before. It's the average true range. The so-called ATR average true range is the average of true ranges over the specified period. ATR measures volatility considering any gaps in the price movement. Typically, the ATR calculation is based on 14 periods, which can be intraday, daily, weekly, or monthly. To measure recent volatility, use a shorter average, such as 2 to 10 periods. For longer-term volatility, use 20 to 50 periods. How this indicator works. An expanding ATR indicates increased volatility in the market, with the range of each bar getting larger. A reversal in price with an increase in ATR would indicate strength behind that move. This indicator is not directional, so an expanding ATR can indicate selling pressure or buying pressure. High ATR values usually result from a sharp advance or decline and are unlikely to be sustained for extended periods. A low ATR value indicates a series of periods with small ranges. These low ATR values are found during extended sideways price action, thus the lower volatility. A prolonged period of low ATR values may indicate a consolidation area and the possibility of a continuation move or reversal. ATR is very useful for stops or entry triggers, signaling changes in volatility. In a nutshell, this is how the indicator functions. But exists better visual presentation of the ATR indicator on TradingView, and I am going to show the best of them that I personally use in a daily basis. The first one is ATR Stop Loss Finder. This indicator calculates average true range even for both buy or sell trade. For example, you have decided in this moment to enter a sell trade based on your confluences. This indicator gives you the safe stop loss zone according to market volatility. If you decide put a tighter stop loss based on the previous candle high, you seriously risk to stop out. So the probability is against you. As you can see, price pullback and didn't stop you out only by luck. If the stop loss could have been 1 pip smaller, the results should have been a lost trade. By placing the stop loss according to ATR indicator, you could have had much more space for price to breath. This indicator will help you to put stop loss to break even too. In a sell position as this example right now, the safest moment to put stop loss to break even, it is when the red band closes below the entry level. Now, I am going to show the second indicator that approximately is the same with the first one, just the visual presentation is different, and you can use it for trailing the stop loss once the trade goes into profits. Here we have a trend change pattern that we often use for a reversal trade. Let's assume that we are going to enter after the bearish candle, the pullback candle. What we usually do, we put the stop loss below the low. But if you want to find out which is the best level to put the stop loss according to market volatility, you should use ATR indicator. The second ATR indicator that we are going to present in this video is the interactive ATR stop loss indicator. After choosing it, we must place it below price for buy trade and above the price for sell trade. In this example we have a buy setup, so we are going to click below the red bearish candle. This indicator shows automatically the stop loss level at this moment. As you can see, it's few pips below our initial one. Once the price goes in the profit, this indicator trails the stop loss. As you can see, it continues till the price touch it, approximately at 1 to 3.9 risk-reward ratio. but you can close the trade manually before this event happens. So, the question, when should I move stop loss to break even? It's officially answered in this video. This is a very effective method that doesn't involve your emotions, and the decision is made automatically by this indicator. Of course, if you want a larger stop loss distance, you can change the multiplier parameter. It's recommended to be 1.5 to 3. Let's change from 1.5 to 2, and we can see the increase of stop loss level. Let's experiment and increase even more. As we can see, by shifting the multiplier value to 3, the trailing stop loss didn't trigger at the first pullback, but continue for another swing. This change also affected our initial stop loss, and in overall the reward didn't change much. Even though with this parameter change, we managed to close the trade far above the previous scenario. We can combine them by using a 1.5 multiplier on the entry, and for trailing the stop loss, we can use 2.5 to 3 multiplier. In this way we have a greater chance to survive without stopping out and holding the trade much longer if our setups plays as forecasted. I hope you find this video helpful. If so, don't forget to like and subscribe.